From New York and London for our audience worldwide, Bloomberg Real Yield starts right now. We begin with the big issue, the lessons of 2020.
If we look at all the things we got wrong,
liquidity matters a great deal.
The big lesson is liquidity.
Endless central bank support.
The amount of borrowing they've been able to do without pushing interest rates up.
We have taken some really extraordinary steps in terms of fiscal and monetary policy.
We probably saw the best set of policies 6 months ago.
If you have someone with a printing press in the basement willing to use it, pay attention.
We investors, we get taught to be overly conservative.
What this year has taught me, certainly, is be more opportunistic.
As we look back, the US was clearly the outperformer.
I wish I had paid more attention to technicals and less attention to fundamentals.
Liquidity is pumped into the market and that floats all boats.
This is no longer a situation where fundamentals are the primary driver.
We're all seeing these black swan events happen with alarming frequency.
We're going to probably have to rewrite some, at least chapters in those textbooks.
I think some of those textbooks need ripping up. Morgan Stanley's Matt Hornbach joins us now for more. Matt, very festive in the background. Great to catch up with you, sir. Let's just start with a lesson of 2020 for you. What is it, Matt?
First of all, happy holidays, John. I hope you have a great year-end. The lesson, as many of your previous speakers suggested, is really about when governments and central banks work together to address a worldwide problem for economies and for the people that contribute to those economies. And I think the central banks and the governments really came together in ways that we haven't seen before in many cases. And so it's really about not working at cross purposes, but working together in unison towards a joint goal is really powerful when it happens. So I think, to me, that was the big lesson of this year.
Let's apply that to markets, Matt. I just wonder whether the conditioning of this year will lead us to make mistakes as we navigate markets in the future. I think we've all been conditioned by experience now to believe that in a pandemic, markets only go up. We've been conditioned now to de-emphasize near-term risks on the hope that things will improve because we have a vaccine. Is this just unique to this moment, Matt, or is there something that we can use in the future? Or is this something that leads us to make mistakes in the years to come?
Well, I think we have to understand exactly what markets are trying to discount about the future. That is really the starting point. It also happens to be difficult to do. But I think looking into next year, it's pretty clear markets are starting to discount the demand impulse that we expect to occur on the back of the vaccine distribution. So, of course, the surprise for next year could be some disruption to that distribution mechanism of the vaccine, or perhaps people being less willing to take it than we all hope. But that is something that markets are starting to discount. And I think also central bank policies are also being discounted through next year, as we can see in the rate market. Rate markets don't think central banks are going to raise rates next year. And of course, most economists don't either. But what about the liquidity that was mentioned in your opening segment? Liquidity is tough to discount in its entirety because we don't always know exactly where it ends up. We of course know that central banks are going to buy a lot of government bonds. The Fed is, of course, going to buy a lot of agency mortgages. And so those assets can discount those flows ahead of time because we know they're going to happen. But what about the second and third moves for that liquidity? Where does it go? That's something I think markets will only be able to fully discount when those flows happen, John, and they just haven't happened yet.
Well, let's talk about what we're discounting at the moment for the back half of next year and what's being priced. We see it in risk assets, we see it in equities. But, Matt, what I see in the bond market right now is a bond market that's really stable. Nominal yields really not doing much. Inflation expectations building, real yields much more negative. Matt, will nominals stay this stable? Is that your base case?
Well, John, we do think that the risk-free asset, the treasury market, is going to have to compete in some form or fashion for capital, especially as the equity markets we think will keep going up and credit spreads keep tightening. The government bond market will have to do a little bit of work to compete for some of that capital. And we think that that comes through in marginally higher interest rates. But the way in which we get there, John, and I think this is to the point of your question, it's not going to be in a straight line. It's not going to occur all in 1 month. It's going to be a grind, I think, towards higher interest rates if the Fed has anything to say about it, which, of course, this past week they did. And I think what you heard from Jay Powell is that he's okay if interest rates go up, but in a controlled fashion, slowly. The Fed is clearly worried about another taper tantrum. And so that will be the key to avoid in 2021.
Matt, when you put these forecasts together for next year, how difficult was it to make a forecast on the long end when seemingly the fate of the long end seems to be in the Fed's hands?
Well, I mean, ultimately, what we think will dominate next year is the market's pricing in of a better economic picture than most forecasters are suggesting. I mean, our chief global economist, Chetan Aya, is above consensus on global growth and inflation. So we think that as that data starts to come through, you will see break-even inflation rates do a lot of the heavy lifting to bring interest rates higher, and real yields less so, because central banks will continue to be dovish, we think. But the break-even inflation rate is going to move higher. And in fact, we wouldn't expect the Fed to even think about raising rates until you started to see break-even inflation rates price above 2.25%. That is going to be higher than where we are today. So we do think tips have some more work to do in 2021.
Matt, you mentioned competing for capital elsewhere. Looking at the bond market in the United States right now, the Treasury market is still the high yielder on the core government bond fixed income universe at the moment. We've got a 10-year over in the UK right now that is lower, lower, lower. We've got the front end that's negative. Got the curve over in Germany, negative all the way out to 10 years through much of this year. Matt, walk me through that dynamic and how powerful that actually is, whether that's an anchor or not for the Treasury market.
Well, I think it absolutely is an anchor. And, this is part of a 30-year trend towards lower global interest rates, ultimately, spearheaded by central banks, right? Central bank policies are the number one driver of government bond markets. And so, of course, we do think that it will be an anchor around the feet of the Treasury market. And that's exactly why, John, we don't see Treasury yields rising dramatically in 2021. I mean, our forecast is for just below a 1.5% 10-year Treasury yield. John, look at a chart. I mean, a 1.5% 10-year yield is, at the beginning of this year would have been very close to an all-time low. That's not a particularly large move for the Treasury market next year.
We closed out last year at 192. Matt, great to catch up, sir, and thank you for everything this year. Your contribution's always valuable. Matt Hornbach there. Enjoy the holidays with the family. Matt Hornbach from Morgan Stanley. Time now for the final spread. The week ahead, coming up next week. Tesla joining the S&P 500 on Monday. Tuesday, the Commerce Department releasing third-quarter GDP figures. Weekly jobless claims falling on Wednesday next week, along with durable goods orders and personal income data as well. Thursday, stock markets closing early, and on Friday, the market closed for Christmas. That is it from us. We'll be away the next couple of weeks. From New York and London for our audience worldwide, this was Bloomberg Real Yield. This is Bloomberg TV.